On the morning of February 28th, 2026, the world woke up to a different planet. Overnight, the United States and Israel launched a coordinated military operation against Iran. The Pentagon named it Operation Epic Fury. More than 1,250 targets were struck inside Iran in the opening hours alone. Iran's supreme leader, Ayatollah Ali Khamenei, who had ruled the country for 37 years, was killed in the first wave of strikes. By the time most Americans had their morning coffee, the Middle East was at war. Within 24 hours, Iran's Revolutionary Guard issued a warning that stopped global shipping in its tracks. No vessel, they announced, was permitted to pass through the Strait of Hormuz. Any ship that attempted to transit would be set ablaze. Most people heard that and thought it was a military problem. It is not. It is an economic one. Depending on how the next 30 days unfold, it could be the most damaging economic shock the world has experienced since the 2008 financial crisis. This is the story of one narrow strip of water, 21 miles wide at its tightest point, and why what happens there in the coming weeks could determine whether the global economy survives intact or fractures in ways that take years to repair. First, you need to understand what the Strait of Hormuz actually is, because most people have no idea. Located between the southern coast of Iran and the northern tip of Oman, the Strait of Hormuz is the only maritime exit from the Persian Gulf into the open ocean. It is 21 miles wide at its narrowest navigable point. And through those 21 miles, every single day, flows approximately 20 million barrels of oil. That represents roughly 20% of all petroleum consumed globally every 24 hours. Not 20% of oil exports, not 20% of traded oil, 20% of everything the entire world burns, drives with, flies on, and manufactures with every single day. On top of that, approximately 20% of the world's entire supply of liquefied natural gas also moves through the same corridor. The majority of it originating from Qatar, which is one of the largest LNG producers on Earth. The U.S. Energy Information Administration has a phrase for the Strait of Hormuz. They call it a choke point. Specifically, they note that most volumes transiting the strait have no alternative means of exiting the region. There is no plan B. There is no parallel route. If the Strait of Hormuz closes, those barrels do not reroute. They simply stop. As of Monday, March 3rd, the strait has not been formally declared closed, but it does not need to be. Ship tracking data from Kpler, one of the leading maritime intelligence firms, shows tanker traffic through the strait has already dropped by approximately 70%. Not because Iran has physically blocked every vessel, but because the commercial shipping industry has done the math and decided the risk is not worth it. Here's how that works. When a shipping company sends a tanker through a war zone, they need insurance. War risk insurance premiums had already hit 6-year highs before the first strike landed. The moment the conflict began, those premiums surged by up to 50% overnight. For a typical crude oil tanker carrying 2 million barrels, a single percentage point increase in insurance equals $2.74 million per voyage. At the current premium levels, transiting the strait has become economically unviable for most commercial operators, even before you factor in the risk of the ship itself being hit. Maersk, one of the largest shipping companies on Earth, has suspended transits. Hapag-Lloyd has done the same. At least 150 tankers, including crude oil and LNG vessels, have dropped anchor in open Gulf waters and are waiting. Not because Iran has physically blocked them, because the math no longer works. The effect on global energy markets has been immediate and violent. On Friday, February 27th, the day before the strikes began, Brent crude oil, the global benchmark, closed at approximately $72 per barrel. By Monday morning Asian trading, it had surged to $80 per barrel. That was an 11% increase in 48 hours before most of the economic damage had even materialized. That is what analysts call the fear premium. Markets do not wait for the supply disruption to actually happen. They price in the probability that it will happen. And right now, that probability is not small. One analyst at MST Marquee described the worst case with unusual bluntness. He said a sustained strait closure combined with attacks on Gulf infrastructure could present a scenario 3 times the severity of the Arab oil embargo and the Iranian Revolution of the 1970s, and drive oil prices into triple digits. For context, in the 1973 Arab oil embargo, oil prices quadrupled in less than a year. The US economy went into recession, inflation exploded, unemployment spiked, lines stretched around the block at gas stations across America. That was a disruption to roughly 7% of global supply. The Strait of Hormuz carries 20%. If oil reaches $100 per barrel and stays there, the knock-on effects arrive fast and compound quickly. Gasoline prices surge at the pump within days. Jet fuel costs spike, hitting airline ticket prices within weeks. Diesel costs rise, which means every truck moving every product across every country gets more expensive to operate. Manufacturing costs climb. Shipping costs climb. And all of those costs eventually land in the same place, the price tag on whatever you are buying. But the oil price is only the first wave. The second wave is what happens to Asia. According to the US Energy Information Administration, 84% of the crude oil that transits the Strait of Hormuz is headed to Asian markets. China, India, Japan, and South Korea together account for nearly 70% of all shipments moving through the corridor. These are not marginal energy consumers. China is the world's largest oil importer. India gets approximately 60% of its total oil imports from the Middle East. Japan and South Korea are almost entirely import dependent for their energy needs. And critically, they don't have unlimited time to wait this out. According to data from Kpler, South Korea holds approximately 3.5 million tons of LNG in reserve. Japan holds roughly 4.4 million tons. At stable consumption rates, those reserves last between 2 and 4 weeks. 2 to 4 weeks. That is the window before South Korea and Japan face genuine physical energy shortages. Not higher prices. Actual shortages. The situation for Qatar, the world's largest liquefied natural gas exporter, has already deteriorated sharply. On Monday, Iranian drones struck facilities at Ras Laffan Industrial City and Mesaieed Industrial City, two of Qatar's primary liquefied natural gas production sites. Qatar preemptively halted liquefied natural gas production in response. Europe, which sources approximately 30% of its jet fuel via the Strait Corridor, is now competing with Asia on spot markets for Atlantic cargoes, driving liquefied natural gas prices higher in both directions simultaneously. There is a third wave, and it's the one that most people haven't started talking about yet. The United States has already spent between $31 billion and $33 billion connected to Middle East conflicts since October 2023. Operation Epic Fury, now in its first week, has deployed more than 20 weapons systems across air, sea, land, and missile defense forces, striking over 1,250 targets. Trump has said the operation could last from 4 to 5 weeks. He has not ruled out ground troops. Wars are expensive in ways that extend far beyond the military budget. Every day of sustained conflict adds pressure to United States Treasury borrowing. It complicates the Federal Reserve's ability to manage inflation. If the Federal Reserve raises interest rates to fight oil-driven inflation, it will simultaneously slow an economy already facing supply shocks. It threatens the dollar's stability as a reserve currency if markets begin pricing in sustained fiscal deterioration. And it arrives at a moment when the United States economy was already absorbing the effects of earlier tariff disruptions, a cooling labor market, and a technology sector in the middle of its own reckoning. OPEC Plus has pledged to increase output by 206,000 barrels per day to try to offset some of the supply disruption. It is not enough. Saudi Arabia and the UAE do have pipeline infrastructure that can bypass the strait, capable of moving approximately 2.6 million barrels per day through alternative routes to the Red Sea. But the strait carries 20 million barrels per day. 2.6 million does not close a 17 million barrel gap. It slows the bleeding. It does not stop it. Russia almost certainly is watching this with considerable interest. With Middle Eastern barrels facing logistical paralysis, both India and China face strong incentives to deepen their reliance on Russian crude, which arrives overland and bypasses the strait entirely. The war between the US and Iran, if sustained, could paradoxically strengthen the one country the US has spent 3 years trying to isolate. So what are the scenarios from here? The best case is a short war. Trump himself has said 4 to 5 weeks. If military operations conclude within that window, if Iran's retaliatory capacity is sufficiently degraded, and if the strait reopens to commercial traffic without further tanker attacks, the economic damage is severe but recoverable. Oil settles somewhere between $85 and $95. Insurance premiums gradually normalize. Asia draws down reserves while rerouted tankers arrive via the Cape of Good Hope, adding approximately 3 weeks to transit times. Inflation spikes globally for a quarter, possibly 2 quarters, then stabilizes. The worst case is a sustained closure. If Iranian forces continue targeting tankers, if Gulf infrastructure including Saudi oil terminals or Qatari LNG facilities sustain significant damage, if the conflict draws in additional regional actors, then the economic math changes completely. Analysts are placing a scenario of oil above $120 per barrel as a genuine tail risk, not a fantasy. At that price level, you are looking at inflation that central banks cannot control without triggering recessions, energy shortages in Asia within weeks, and a global trade disruption that makes the Red Sea crisis of 2024 look like a minor inconvenience. 3 things this crisis reveals about the world we actually live in. First, global energy infrastructure has a single point of failure, and we built the entire modern economy around it. Decades of economists assured governments that energy markets were resilient and self-correcting. 21 miles of water between Iran and Oman has just reminded everyone how fragile that assumption always was. Second, a war in the Middle East is now a simultaneous economic crisis everywhere. China is not a party to this conflict. Japan is not a party to this conflict. South Korea is not a party to this conflict. None of them have any say in how it unfolds. All of them will feel it in their energy budgets within weeks. Globalization did not just connect supply chains, it connected vulnerabilities. Third, the cost of this conflict is not abstract. It will arrive in your daily life in the most ordinary ways. At the gas pump, in your electricity bill, in the price of every product that was made somewhere, shipped somewhere, or delivered somewhere by anything that runs on fuel, which is to say, nearly everything. On February 28, 2026, a military operation began in Iran. Within 48 hours, oil prices had jumped 11%. Shipping through the world's most critical energy choke point had ground to a near halt. Japan and South Korea were staring at energy reserves measured in weeks. And 150 tankers were anchored in open water, waiting to see what happens next. The strikes lasted hours. The economic consequences will last months. Whether this becomes a footnote or a turning point depends almost entirely on what happens in the next 30 days, inside 21 miles of water that most people could not find on a map. The world is watching the Strait of Hormuz. The Strait of Hormuz does not care.